All right. Well, welcome back. We are at Indaba Coffee for this month's monthly real estate update for September 2025. I got to be careful not to shake the table. Um, so, this video might be just a little bit longer because we're going to break it up into the real estate update. We're going to talk a bit about Fed funds rates and the impact that that has or doesn't have on the 30-year mortgage rate. And then also chat about ARMs. Starting to see that a lot more in our market right now. So Mike will dive into adjustable rate mortgages and how those work. So I'm just kind of kicking off real estate market for September of 2025. Saw our median price stay at 410. Year over year, that's down 3.5%. Continuing to see new listings come onto the market. We saw a 13.5% increase year over year for listings onto the market. And that's kind of keeping inventory high. So right now we have a little over 3,400 active homes on the market, which is a 40% increase year over year. We are seeing it a little bit slower as far as like the actual like activity in the market. We've seen our absorption rate, which is the percentage of homes that go under contract in that time period. And we saw that go from 26 down to 19%. The amount of decisions being made and homes going under contract is slowing, combined with increased inventory.
Well, I think that could somewhat be seasonal. Someone was just asking me the other day, where I thought the marketing thing was going. And I said, for a very long time, the month that we closed the fewest number of loans was September. And I don't know if it's because people take vacation in August, so they're not looking for real estate, or we took vacation in August and we weren't talking to people, or people didn't want to move after school started. So sometimes I think, September can just be slow. And I read an article today that said October is actually the best month to buy a house across the country.
Yeah, yeah. And I think on the, like we're definitely seeing that slowing pace a bit. Mortgage rates have kind of stayed stubbornly in the, low to mid sixes, depending on score and loan type and all that stuff. We did see, year over year, the average cost of a mortgage is down about 1%, which, it's a little over a $20 a month savings, but that's kind of moving down in the right direction. So
I think if you're looking at September from a rate standpoint, from my standpoint, it's actually probably been one of the best months we've had in the last year. Rates actually got better in September, and it wasn't a quick drop and then quick rise. It was a pretty steady thing. I think some of it was based upon the assumption the Federal Reserve Bank was going to lower the rates, which they did. The rates kind of ticked up a little bit after that because I think we're going to talk later. There's no direct correlation between those two rates, but I mean, all in all, mortgage rates have stayed pretty steady, which is nice. It's nice if you talk to us on Monday and we tell you what the rate is, and on Friday when you offer on the house, they're the same.
yeah, yeah, that is
Or
pretty
gone
nice.
down a little bit.
Yeah. So, I mean, for a seller in this market, price and condition, price and condition, price and condition, like there's no amount of marketing that is going to outmarket an overpriced or underconditioned home relative to what's happening in the immediate area. Like it's impossible. And so, right now for sellers, like it's taking a little longer time to sell. Surprisingly, even the ones that are in, good condition, if you're just a little bit off on price, it may take a price reduction or it may take a little more time for a buyer to make a decision. If you're a buyer in this market, like I'm seeing more room for negotiation on price, concessions. You don't have to have FOMO, like you have options and things to choose from, like as we've seen with inventory increasing 40% year over year.
Well, and I think also both as a seller and a buyer, you can also be creative. I mean, with a conventional loan, if you put 10% down, you can get up to 6% seller concession. So if you're a seller and you're having a concession where you can buy someone a rate down from, say, the low sixes where we're at today to the low fives to a rate that is probably going to last for a long time before you'd ever even consider refinancing out of it. I think as a buyer, you can ask for that. And as a seller, if you're willing to do that, it could make your house more attractive.
Yeah, and I mean, a great example of that is I had a client that he's purchasing a Lennar home, and they were either offering a 15% price reduction on a $525,000 home, so you could get it for 465, or you could get a 4.99 30-year fixed or a 3.875 7-year ARM. The rates beat out the price reduction in both scenarios.
Yeah, for sure. And I think as you're mentioning about ARMs, I do think adjustable rate mortgages are going to become more popular as rates continue to stay what are probably over the long haul are a decent long-term rate, but what we're used to is a higher rate. And like with a 7-year ARM, if you took that rate, if you're not going to be in that house for 7 years, you don't take any risk in that rate adjusting. And there is even a chance, sometimes it did happen in the past, where rates had actually adjusted down.
Yeah. So let's switch gears a little bit. We're going to talk about the Federal Reserve cuts and the 30-year mortgage rate. I can't tell you how many posts and articles I saw that the Fed's cutting rates. It's about time. 30-year mortgage rate's going to go down.
And well, I've read lots of those too. And the reality is when they cut rates, the actual announcement came, rates ticked up a little bit.
Yeah. And we started off, the video with really the tagline is buy the rumor, sell the news. And so what I mean by that is when you hear chatter about the Fed cutting rates, if they're going to do it 2 or 3 times this year, when they meet next, where you want to be taking action if you're trying to time the market is when you start hearing chatter ahead of their meeting. If you wait until after they cut rates, I mean, we're going to put this chart in the newsletter, but the last couple of times that they've actually cut rates, mortgages have gone up.
Yeah, I think part of it is people have already priced in the rate reduction by the Federal Reserve Bank. And like you said, if you're waiting for the announcement, for instance, if you think they're going to drop rates a quarter point in November and they don't drop a quarter point, rates are going to go up, right? Because that will have surprised the market, and surprises are rarely good.
Yeah. So one of the charts we're going to put in there is the 30-year mortgage rate versus the federal funds rate. What's really telling to me, and I'm not going to hold it up and show it to you, but you're going to see 2 prolonged periods of time where the Fed took no action. So in basically July of 2023, the Fed from July 2023 to September of 24 cut the rates 0 times. What happened is the individual handled the market where you let the free market capital market actually work. Rates went from 7.8% to 6.2% over that same period of time. That's with 0 Fed rate cuts. The Fed did their first rate cut in September of 24, and it was about a half of a percent rate cut, 50 basis points. Rates went from 6.2% up to 6.9%. And then they did a couple other cuts, and so those same cuts where they did 2 quarter point basis or quarter percentage cuts, rates went up. Then you had this flat period of time from January of 25 until September of 25, where rates went from just a little over 7 down to where we saw them at their year low. Fed just recently cut rates. Rates are trending back up again over the last 2 weeks. The Fed rate cut for mortgages does not matter.
It does. It's not matter. There's no correlation between it. If you want to look at anything other than mortgage rates themselves, the 10-year Treasury and 30-year fixed rates tend to follow each other. But the Federal Reserve Bank overnight rate does not have any effect on mortgage rates. The other thing, if you really want to watch mortgage rates, and another thing, it would be inflation. And if you're into cutting that down even more, you can look at the cost of a barrel of oil, because the reality is the cost of oil is a significant player in the cost of goods. It's really hard to have anything that doesn't touch oil, either transportation or any of those sorts of things. So those are things, if I was watching a chart and I was worried or I wanted to know where mortgage rates were going, I wouldn't listen to the Federal Reserve Bank. I would look at inflation, and if you want to break that down, I'd look at oil prices.
Yeah, I mean, so if we touch on the Fed a little bit more, the Fed policy right now is to get back to a neutral 3 to 3.5% rate, right? So if the Fed is going to neutral, they're not trying to contract money supply and they're not trying to expand money supply. Why would we see a massive move in interest rates on the mortgage side when the Fed is literally neutral?
Oh, I don't think we would. And I think the other thing that maybe we should clarify, what the Fed funds rate is that you hear about and talk about, it's what banks can borrow money from the Fed at. And they call it the overnight rate because the Fed can change their rates anytime they want. So it's not, it could have a correlation on car loans and those sorts of things, because that's their borrowing cost. But it doesn't have an effect on mortgage rates.
Yeah. So I think just to summarize, if you're going to try and time it, get in when you start hearing the chatter of the Fed's going to lower rates. Mortgage rates have typically moved positively in that sense. Second thing is the Fed's neutral. Mortgage rates are most likely going to be neutral. And the third thing is like I wouldn't underestimate the invisible hand of the market where like when the economy like actually does not have government intervention, it tends to work itself out.
Yeah, for sure it does. And I
Yeah.
think that, like you said, as the Fed Reserve gets to the point where they want to be neutral, mortgage rates and all other rates will be neutral, that unemployment will be neutral, the stock market will be neutral, and things will just kind of tick along. And in my opinion, that is not a mortgage rate, under 5%. That's probably between 5 and 6%. It's probably a neutral long-term rate
Yeah.
on a 30-year fix.
Yeah. And so, I mean, and we'll include these other couple of charts too, but like I ran a couple of scenarios of projecting where the Fed funds rate might be and where mortgage rates might be 2 years, 3 years out. It's not that much of a change. However, like it is enough to where like if you locked in today and you wanted to refinance, you're locking in price, you're either locking in your rate or you're getting creative with how you're financing the home so that you can finance out of it if and when if you're up against a time frame or something along those lines. So on the short term, I think transitioning over to arms and explaining those a little bit like might be a way to hedge your bet if in fact like they do continue to trend down. It's not drastic though. I mean, you might get to like 5.5, 5.25.
Yeah, no, I agree. I think that's probably the long-term betterment of rates, and I think that we're talking 2 or 3 years down the road, right? We're not talking 2 or 3 months down the road. Fannie Mae has come out and said they project, 30-year fixed mortgage rates by the end of 2026 could be under 6%. We're really close to 6% now, so it's not a big gap
Yeah.
or change.
Yeah. So what is? I'm hearing more about arms. What is an arm? How does it work? What are the pros and cons of them?
So an ARM is, a short thing for adjustable rate mortgage, and what they are is they're adjustable. So when you hear of a 10-1 ARM or a 7-1 ARM or 5-1 ARM, the first number is the number of years that rate is fixed. So if you heard of a 10-1 ARM at 5.25%, that means you'd have 5.25% for 10 years, and then the rate can adjust. They're usually based upon some index. Either the 10-year Treasury note is a popular one that they're based on. So depending on what the Treasury does, would base, if it's say a margin of 2 points above that, the Treasury's at 4, then it would adjust to 6 down the road. Now that being said, if you're looking at being in, especially if you're a first-time home buyer, and this is your first house, and you're only going to be there 5 to 7 years, well, a 10-year ARM probably doesn't even come into play for you because you're going to be moving to your next house after that. So I think adjustable rate mortgages have tended to have a negative connotation, but they don't have to be. They actually, as a matter of fact, depending on what's going on in the economy, I know people that took an adjustable rate mortgage because they felt like they just needed to get in the house, and then they called and said, "I want to refinance my rate is about to go up," and I looked at them like, "Actually, your rate's about to go down. You're actually can adjust down. I mean, if the margin is based upon a factor that's gone down, then you actually could get a better rate." So I don't think that ARMs necessarily, they're not for everybody, but I certainly think if you're looking to purchase a house, it's something you should consider. If you can get a better interest rate and make it more affordable, even if it's a 5, 7, or 10-year period, that's typically because they amortize over 30 years. I mean, the reason most people use a 30-year loan is it's the most affordable, right? 15-year loans are great. You pay our house off faster in 15 years, but it also means a much higher payment. So that's why you don't see 15-year mortgage as popular as one that amortizes over 30 years.
So if you have an arm, you have the fixed rate for whatever that first number is. Let's say rates trend up. What's the maximum it could go up? I mean, because we're talking payment change that's substantial. So what's the risk on the upside?
Well, typically, like you see, sometimes it's like they'd call it a 10-1, meaning to readjust the first time in 10 years, and a 2, meaning the highest it could go up would be 2. Okay. So if you were at 6% today, it could go as high as 8% in the first adjustment. And then after that adjustment, typically they would only go up half a point at the maximum.
And what's the average amount of time that somebody's in an actual loan? Not the house, but like, let's just say they plan on staying in the house for 20 years. What's the maximum amount of time on average that
I
somebody's
would
in a
think
loan?
the average number of time that people are alone are typically about 6 years. Now, granted, if you look back at COVID, everybody was trying to refinance during that time. But if you look at periods of time where, there wasn't federal intervention and things went smoothly, it's about a 5 to 6 year period that they'd be in the loan. Either rates would have improved enough to refinance or they have moved on to a different home.
Yeah. So, and my point with that question is like, even if you're not planning on selling the house, you can still refinance. And the average time that somebody's in a loan is 5 to 6 years before the rate's either favorable or there's a need,
Correct.
right?
Yeah.
Yeah.
I mean, I would think also if you did stay in the house for 10 years and rates were the same, then your rate would probably stay about the same. If rates were lower, then it would probably adjust lower. And if rates were higher, you could see that coming in year 8, 9, and you could say, okay, I think this is the trend where we're going, that maybe we should refinance now while rates are a 30-year fix would be lower than what our rate will adjust to.
Okay. And for the investors that might be watching, can you do an ARM on an investment
You
property?
can, yeah. You absolutely can. Even on a DSCR. Not to get too deep in the woods, the reason ARMs haven't been very popular over the last few years has to do with the inverted yield curve, and that, long-term money was actually cheaper than short-term money. Those things are starting to change, and that's why ARMs are starting to come back to being popular again.
Okay. So if you're average consumer or investor, it's a great way to lock in a low rate with a payment that's amortized over a 30-year time period. So you get a lower interest rate, lower monthly payment. And if you're worried about short-term fluctuations, just do a longer ARM.
Correct. And I think the other kind of mortgage trick, if you would, if you're an investor and you're putting enough money down or you have enough equity in your property now, looking at an interest-only payment is not a bad option. It can make your property cash flow. And if you already have 25 or 30% equity anyway, you're protected in your equity standpoint, and you could still, if you had to sell the house, you would have equity. So there are some things, hacks, if you will, that can make a house more affordable and maybe a purchase or a refinance more attractive to you.
Awesome. Well, if you guys do have questions about purchasing, refinancing, mortgage products, we can be reached at SpokaneHomeGuy.com or 509-990-SOLD. And where can you
Or
be reached?
ChimneyRockMortgage.com or 509-747-1300.
Awesome. Have a great day.